This is the Digitization of Securities panel. I'd like to introduce Tony Evans, co-founder of FGC Group. And Jan Summit, founder of CEO at RefToken. Ralph Liu, CEO of TurboChains and CEO of MuleChain. And Shacham, attorney and real estate appraiser. Here we are going to have a discussion about the digitization of securities, opportunities and challenges. This is also known as the tokenization of securities. So to start, I'd like to give each of our panelists the opportunity to introduce themselves and share a little bit of info about them.
Thank you very much. I'm Tony Evans, I'm co-founder of FGC. I'm here today with my co-founder, Kingsley Kobayashi. We're based out of Japan, been in the field of digital assets for 5 years, before that in finance. Been very, very fortunate to be based in Japan, which has taken this like crazy, and Asia has been leading the way in this. We are specialized in helping entry market into Japan, also finance and also exchange listings.
I'm Jan Sammut. I'm the founder and CEO of ICO Launch Malta alongside of RefToken. RefToken is a decentralized affiliate platform. It's a DApp, it's in beta, but today I'm here in capacity as CEO of ICO Launch Malta, which is basically a full-service STO service provider. And in a nutshell, what we do is we create cryptographic analogs of traditional financial instruments.
My name is Ralph Liu. I'm the founder and CEO for two companies related to blockchain. That's MuleChain and TurboChains. So MuleChain is a personal delivery and storage service. So for example, if you come to visit me in Los Angeles and somebody asks you to bring a jacket for his daughter studying at UCLA, and if you do, they pay you $100, then you become a Mule on the MuleChain platform. So basically we want everybody to be able to make money out of a decentralized platform. And TurboChains is actually a technology company. And it provides something like WeChat Pay. It's a mobile payment, social networking, and m-commerce. And we only deliver that on a white label basis. So by profession, I'm an investment banker. So I help a lot of people, raise money. And today we'll talk a little bit about our experience in the regulated ICO in the US.
Good morning, next blog. How are ya? All right. My name is Shacham. I do crypto asset and real estate tax engineering. I'm a lawyer, taxman, real estate appraiser. I'm an associate advisor for some companies in the blockchain world. And I'd like to help people pay less taxes legally.
So since we're talking about legal and taxes, I guess we'll start with Ido on what are some of the legal benefits of tokenization?
Well, most of the stuff has to do with the problems you have on the underlying asset. Usually, if you have a real estate asset, it's very difficult to move ownership. It's very difficult to verify ownership. Supposing I came here to Sofia and someone showed me a nice apartment and I wanted to buy it. It would be difficult for me to know if the person showing me is the owner, how much the apartment is worth, what are the attributes of the apartment. And if it was tokenized on the blockchain, there would be more clarity. It would be much easier for me if I had a token. It also allows crowdfunding for the base owner, so he could share part of his asset. It also allows democratization of real estate or other base assets by giving a fractional ownership to the token holder. So it's good things. It's just a few examples. I
Yep.
could go for an hour.
Sure, and then Ralph, if you don't mind, just share a little bit about other benefits of tokenization.
Well, I guess one of the major thing is just trading liquidity, and in addition, a lot of pool of available money. So let me just share with everybody, some of my personal experience. About 10 or 15 years ago, I really started 15 years ago, and has the idea of fractional share ownership of real estate. So even today, you can Google online, and that program is called a FARJO. That stands for Flexible and Reversible Joint Home Ownership. Basically, the idea is you let people just equity sharing. You don't need a mortgage anymore. So the way to accomplish that is through securitization in the past. So I personally spent a lot of time, a lot of money, trying to promote that business in the earlier days, but the technology wasn't there. And basically, if you want to securitize it, you form an LLC. You treat each home as a company. We're basically trying to provide a stock exchange for each single family home. Then anybody can sell a partial equity. The idea is very good, We championed it and all that. Then came the financial crisis in 2008, 2009. So then we were trying to work with a Wall Street firm, but during that time, the Wall Street firm lost the credibility. They couldn't do it. So, put a long story short, we put that on the side. Fast forward, I put it on the back burner, with all that money, even filed patents and all that. So in 2017, that's how I discovered the thing about ICO. So lo and behold, you find out a lot of young kids, the tech hackers, they don't have any investment banking background or even legal background. But all of a sudden, they own the product. I spent over decades trying to accomplish. That is tokenization. Because tokenization, by nature, is fractional share. So that goes without saying. The tokenization provides a lot of liquidity. And in addition, why they are so successful? Because they're simply a pool of funds of the cryptocurrency owner started by the Bitcoin and Ether. Therefore, right now you can accomplish the tokenization to realize the fractional share goal. So let me just leave it like that. I'll follow up with this later on.
And then for Jan and for Tony, if you could both, I guess, start with Jan, maybe give some of the risks or negatives of tokenization and maybe some of the considerations that an issuer should look into before deciding to go the tokenization route.
So, from a risk point of view, these mostly come from the novelty of the sector. So sometimes, basically, I would go as far as saying in 100% of the world's jurisdictions, and we're talking about securities here, we're talking about SDO, so everything that's regulated. The legislation has not caught up with the technology yet. So the stuff you can do, you can go much further with the technology than you can within the legal framework. So one of the challenges is actually, for us as an advisory company, is actually reining in the clients and telling them, listen, yes, all the stuff you want to do is really great, but a regulator will never understand it, get their head around it, or sign off on it. The second challenge is, even though a lot of the more forward-looking funds, family offices, etc., are looking at, are very interested in SDOs, particularly when it comes to offerings that are in their comfort zone. So, for example, tokenized real estate is something that we're seeing a lot of Central European family offices like snap up, left, right, and center. We have clients of ours that are on their third or fourth, issuance. There's still a lot of institutional money or kind of semi-institutional money, high net worth individual funds, etc., which still have a bit of a stigma towards it. because they conflate an STO with an ICO, they solve the crash, they solve the bubble, etc. So these are the two primary challenges or risks to an issuer. One is the regulatory approval and not running away with what the technology can do and maintaining and building your offering around the regulatory framework. And the second is actually the remnants of stigma and resistance to the new investment instrument.
And Tony, if you could share a little bit about what you see as the main risks as an issuer in tokenizing a security.
It's actually looking at it from both sides. It's the issuer itself not understanding the legal framework, the jurisdiction, the taxation, and mixing it up with an ICO. That's one of the big problems we see, is a lot of confusion between ICO and STO, and that goes to investors as well. We don't see the people understanding how the market has evolved. People are just catching up into Bitcoin. The thing is so much similar to the internet, when the internet started, and how that was evolved, and there was a bubble and a crash, and then it evolved into a better format. And Jan said it correctly, is the technology. The technology is so far advanced, people haven't caught up to it yet. Regulators are even worse. They're still looking at Bitcoin, okay? And Bitcoin's over 10 years old, okay? So this is one of the things that we're seeing a big problem with, is like people are trying to do a global business, but there's always a problem with local jurisdiction, okay? Like Japan has a jurisdiction on Bitcoin and crypto, but for STOs, it's still a little bit grey at the moment. It's the same across the world. There's a grey area, and as such, the market is so small. It's only around $150 billion. It wouldn't even be a large company on the US stock exchange. So we're in the infancy, and that's the part where we see a lot of institutional money not coming in, because it's slightly too small for them at the moment. So the problem is the technology is going so fast where people and regulators cannot catch up.
I want to weigh in on that.
Yeah, I figured you would be good on the risk question.
Yeah, okay. So it's true that the regulatory stuff is very important, and if you don't comply, then there won't be a tokenization. You could be banned, and that is very important. But we also have to understand that we're not selling the base asset. So the market is different. It's based on a valuation, whether it be a valuation of real estate, or whether it be a valuation of IP, or whether it be valuation of a drug that is okayed by the FDA. This valuation has to have due diligence within the company that is tokenizing it, because if it's overvalued, and the market, which is sometimes smarter than all of us, will realize that, then the token will be worthless and nobody will buy it. So part of my job in Solid Block is to make sure that the valuations are correct and not higher.
I totally agree with you. The whole thing is there's no accountability with a lot of these people, okay? There's no accountability to the investors, there's no accountability to the shareholders, and also the token. So the whole thing is there's so much mixture, and they're trying to hide all this in what people understand. And this is a totally new asset class and how it works. But they're trying to hide it in a way that people get mixed up, and they only see the bright side of it's going to keep on going up. And that's the crazy part. The human beings are very, very simple. We have two emotions, fear and greed. It's one or the other that actually makes us make decisions.
Definitely, definitely. And you see, it only works when everybody wins.
Exactly.
If someone gets too greedy, on the base asset, then this thing doesn't work, and we will have the problems that we have in the ICO.
Of course, the thing is the market is cleverer than us. The market will burn the whole thing down, because there's only so much you can push, and the human beings will then come in and actually destroy it, and the market will reset itself, and then we'll have to move forward again. But it will create a stronger foundation.
I would like to add a little bit from a practical point of view, So if you look at the digitized tokens, or you have a securitized token, either way, what you end up, yes, you have the advantage of trading liquidity. But from a practical point of view, think about what is a major problem of cryptocurrency: the custodian. So now comparing the traditional investor, if I'm an investor, If I really want to make money as a speculator, I wouldn't touch asset tokens. I would stick to a utility token. Because once you link to underlying asset, the performance of asset token will never be higher than what the underlying asset is. That's number one. Number two, think about the difficulty. If you're targeting digitized asset token, that's relatively much small percentage of people in the world. Because what is a major problem? No custodian. If you lose your wallet, lose your account, that thing disappears. But if you have a traditional stock certificate, it's much easier to handle in terms of custodian. So this is one of the major hurdle to make asset tokens successful.
So, Jan, how would you prevent, based on what Ralph was saying, how would you prevent the tokens from being similar to like bearer bonds?
So this is quite a challenge because generally once you have a tokenized asset and that token is freely tradable, or whether you're tokenizing a company and basically the token represents a share class, for example. What happens is the freely tradable nature of a typical ERC20 token makes that a bearer bond, or a bearer share, which is generally illegal. So we have as a company structured tokens where they are not freely tradable, transferable. So if Bob buys the token in your STO, he can't just send the token to Alice. Alice would need to go into the issuer's website, do her KYC and AML, get whitelisted, and then she can receive the token. Otherwise, the transaction will just fail. So what we're doing is, from that end, is actually we're re-centralizing a decentralized protocol. And the reason why there's a certain requirement for this, in this particular case of a security token offering, is that an STO issuer is, by its own innate nature, just about the most centralized implementation of the technology, manifestation of the technology you can have. There's a board of directors, there's a CAO, there's a legal counsel, and there are people that can get arrested and thrown into jail if something goes wrong. So, there's no moral qualms on our side of re-centralizing this. So the key takeaway of this is, again, the technology was built in the spirit of a very peer-to-peer rebellious ethos. And once we start looking at it in the context of regulated securities, we need to start paring that back and actually start stripping away some of those layers to make it palatable both to regulators, but also to insulate the issuers from potential legal repercussions.
It looks like you have something to add.
Yes, I do. You see, you said, how do we solve this problem? And I think that what we do, I'm not a tech guy. Okay, I'm not a tech guy, but I know that you can program within the token, the KYC, the anti-money laundering, and also you can connect it to identity, and you can take that identity and connect it to the custodian, which sometimes run it. It's true, we have different type of users. Okay, we have the early adapters, which want to hold their own wallet, which know exactly what they're doing, which won't lose it easily. And we have the slow investors, which are they want in on the game because they want to make money. They want to be in a security field because it's connected to a base asset. And to your example of the utility tokens, the reason people like security because there's a connection to the base asset. There is a base asset out there that is connected. Imagine that you have like a brick, okay? The brick is the base asset, and it's connected with a string to a balloon. The balloon is the token. If it wasn't connected to a base asset, the balloon could fly away and disconnect and lose its value because the market could go wild. Well, as you have a good business, whether it be utility or security, and it's connected, so we have a parallel market which has a slower intake of making more money, but it's more secure, and people want that.
It actually reminds me a little bit of the success of ETF index funds And since those came out, they've been mass adoption. And I believe, too, the next big step for crypto would, of course, would be a Bitcoin or Ethereum ETF.
Yeah. So basically, just to kind of finish, loop around to your comments, I can only speak obviously to the way that we engineer these tokens, and yes, in fact, the KYC is not, in essence, not inbuilt in the token; it's inbuilt in the smart contract. Whereas we create a cryptographic register of shareholders or token holders, which is accessible to the issuer or to the regulators if they require access. And secondly, we also have the ability to create what internally our engineers have called the steal function, which isn't at all a steal function, but what it allows us is if someone had to lose custody of their tokens or their wallet and can prove it, or there's a court order, for example, where tokens or shares or whatever need to be seized, we can actually pull them from someone's wallet and drop them into another account. So if there is a court order where assets need to be traded, or if, for example, we can implement this in the terms of, for example, a tag-along right or a drag-along right in the case of a company acquisition, what we'd be able to do is actually pull everyone's tokens and either replace them with others, replace them with Ether, or anything of the sort, just without the user's consent.
Just to tell you, I said I'm not a tech guy, but I am a consultant to Solid Block, and most of the stuff you were saying that was done externally is done inside their coin. So if you want to transfer the coin, you have to pass all the stuff inside. Okay, everything is already on the transferring. You do the offering of the coin when it's off lockdown, and the other person has to fill it in.
But isn't it possible the nature of a crypto or token acting as a bearer bond, where if you have it, then that's yours? Couldn't that be seen as a benefit? And I'll give an example, like if you're living in an oppressed political regime somewhere, the government can come in Zimbabwe and just take your money, or North Korea, or many other places around the world, and over time it changes. So I believe one of the benefits of a bearer bond was no matter who came in, as long as you have that piece of paper, it's yours. So couldn't it actually be a benefit, and shouldn't maybe the market, instead of trying to hide the fact that it is like a bearer bond, maybe promote it as a safe haven, something that can stay with
The thing is, okay, is like you just described human nature, okay? It's like water. Water gives us life, but also can kill us, okay? So when you think about bearer bond, it can be used for good, but it can also be used for bad. The whole situation is there has to be a middle ground. I think we've talked about how the technology has gone so far, the decentralization has gone so far, but we as human beings haven't evolved that fast in regards how do we think, how do we see investments, how do we want to have the paper certificate, as Ralph said. It's all about the accountability, and that's the path that the technology and everything, there's only a small amount of the people taking this up. I think we as a market has to evolve, and we're probably 2 generations away until this actually kicks into what we see and we believe right now. I think everybody now, ETFs is now taking off, but this is 20 years in the making, and thereabouts. So it's the finance has to catch up to the people.
My take on this is that your example is very different, as a totally different use case from the use case that we're discussing here. If I were, for example, just to give you an example, a Zimbabwean farmer, whatever oppressed regime, a bearer bond on my farm is more or less useless because an oppressive regime would still be able to take over my farm, basically through the courts or through a martial order. Your example is, and I agree with it wholeheartedly, is when it comes to money and the store of value. When it comes to cryptocurrencies, which are purely a currency, which are means of exchange, peer-to-peer cash, yes, then I'm one of the largest proponents for decentralization and pseudonymy, etc. But in this instance, we're talking about regulated offerings, where a company goes to a financial services authority, a regulator, puts on their paperwork, and it's backed by real people.
How is that not a storage of wealth, like a stock? It's a way to put money.
Well, it's an asset, so it's a transferable asset, but the difference is simply that it's coming from, it is being issued by a legal entity, by a legal person. The fundamental difference is that, for example, the ultimate case is Bitcoin, which is launched by there's no actual entity behind it, and to a lesser extent Ethereum, which is kind of the Ethereum Foundation, which again have open sourced it and just given it out, and the Ethereum Foundation is simply responsible for promoting it and promoting its adoption. As opposed to a company that, for example, is tokenizing a piece of real estate, where ABC Limited owns this piece of land. I am the director. You're the CEO. We're the ones that go to jail if something goes wrong. Once our tokens may be used as a transactional instrument, the fact that we're filing, part of the requirements of our licensing and actually running our issue in a compliant manner requires closing these loopholes. It's just as simple as that. If you want to create something that is an anonymous, unhinderable store of value, then basically fork Litecoin, put in Z-snarks, and you've got full privacy, and off you go.
Ralph?
Yes. To me, if you look at the bearer bonds in the future, that's really the goal. I think that provides a lot of utility to it. Now, to begin with, because of the security selling process, and for example, in the US, if you have a private placement for Reg D, you basically have to wait for 1 year to become freely, distributable to anybody, which is not accredited investors. So eventually, but if you do it on the Reg A plus, since day one, you're free to transfer to any other holders. Now, what is the advantage? What is the benefit of asset token? You see, I don't want to call it security token because a lot of people sort of get confused about all this idea. There's no such thing as a security token. There are 3 types of token. There are currency tokens, such as Bitcoin, Ether. There are utility tokens, on the platform token. Then you got asset token. The security concept, the terminology, comes from the regulator. If you want to raise investors' money, no matter what you sell, either utility token or asset token, you are selling a securities. So security is really just a legal term. It doesn't really matter. You're selling shoes to raise money from investors, selling clothes, that's a security. So put into that context, because of the whole legal process of raising money from investors, you have to wait for a period. You are limited to the accredited investor. But eventually, they're freely distributable. That will provide a lot of advantage. So in my view, what the asset token in the future, without the restriction, if you're comparing the asset token versus utility token, the same analogy is what a stable coin versus a Bitcoin. Because both of them stable coins backed by a stable fiat currency. Asset tokens backed by the underlying assets. So eventually they will provide the same type of economic value in the future.
Okay, so I want to start with your first question, which was the people who want to keep bearer bonds in order for a rainy day. Okay, you want to keep a coin. For my grandfather used to say, you have to keep a gold coin for a rainy day. Okay, so let's start with the industry. The industry is very young. If you would compare our industry to the life of a person, I guess we would be 6 years old. We would go to school right now and learn how to read and write. And I'll explain how that is working out on the regulatory side with a story. There used to be a Roman emperor. His name was Aspianus. Okay? Aspianus decided to tax lutras. They weren't taxed before this. Lutras are toilets. His son came up to him and said, "Dad, why are you taxing the lutras?" So Aspianus came to the vault, opened the door, took the money out. The money was made of gold back in the day. Gave it to his son to hold in his hand and told him, "Hold it." He held it. He said, "Now smell it." He smelled it. And the son, and Aspianus said, "What does it smell like?" The son said, "It has no smell, Dad." that's a bear bond. It has no smell, it has no trace, but we want a trace. Why do we want a trace? We want the internet footprint, we want to know where money is coming and going because we don't want people abusing it. We don't want terrorism, we don't want crime, we don't want the bad things to happen to our society. That's why we have the regulations of the KYC and we have all that stuff. It's true that there are some situations that people want to keep money for a rainy day. And you're saying they're really trapped in a regime, we need to help them. But that is the exception to the rule. Okay? If you look at the technology, it's used mostly in areas that are affluent and are visible to people. And the people who use it as a bear bond will usually use it for less normal purposes. And about your point that you just said before, that it is true that the regulators decided how to describe they put the name of the utility token and the security token. And I agree that if there is a business underneath, the base asset is a business. It doesn't matter if it's a utility or a security, but the different definitions are in the definitions that the regulator can see and understand. If you look at the regulative process, it's really a mirror to the economic market, but it's warped. It's warped because it comes from how they see the industry from the outside. They don't live it like us. We're living it. They're seeing it from the outside. This is what they can compare. This is what they can understand. And I believe that in the future, these things will change.
And then, Jan, could you give us an example of how tokenization has provided a paradigm shift in a specific asset offering and how that asset has benefited?
Okay, so basically the main advantages of tokenization comes in two forms. One, increased liquidity, and secondly, greater price discovery, which is a function of greater liquidity. So an example is, very real-world example, one client, they own a very large ancient art collection. It's Chinese art, it's extremely fragmented. We're talking large numbers, we're talking pieces that go for anything between 18 and 30 million. However, it's extremely fragmented according to era and artist, and I'm definitely not an expert in the subject. But the issue is that these pieces come up for sale very, very rarely, once every few years. So it's very hard to discover the price. Overall, the market is trending upwards, but it's very hard to get a price comparison. What does this particular item, what is the valuation of this particular item now in comparison over the last 5 years versus what it was 5 years ago? Similar application is very rare and fine wine, which is a very large market, but very thinly traded. So once you fractionalize these pieces, once you get a $30 million piece of art or antique or whatnot, and you fractionalize it so people can go in and buy 100 euros, 1,000 euros just to get exposure to that asset class, which is basically an alternative asset class like gold or whatnot. And that is traded, then suddenly you have a greater liquidity. So if you wanted to exit from your investment or actually increase your holdings in it, you can in a manner that kind of won't eat up the spread, basically, so to speak. And secondly, there's price discovery. It's, you know exactly how much it's worth at any moment. Because if you buy, I'll give an example that I'm very familiar with because I'm a car nut. If you want to buy, for example, a very rare classic car, say some of the really exotic rare Ferraris, for example, they come for sale once every 5 years. So you're going to have to pay more than it was the last time, but how much? Whereas if it was fractionalized, you'd be able to look at the market and say, listen, you know what, over the last 3 months, this has been trending roughly around this much. And that's a very bad example, but just to give an example. So yes, the shift is increased liquidity and price discovery, where it allows people to come in and out of an investment rapidly with very little pain, and also knowing exactly how much they're going to pay for it or how much they can expect to collect for it.
Which asset classes specifically are primed for tokenization right now?
Okay. Commercial real estate is a massive use case. There's also the benefit because buying and selling real estate is generally an extremely painful process. So if I wanted to buy a fraction of, say, this building here, it would be a paperwork nightmare. Whereas if it's tokenized, I'd be able to come in and say, listen, I want to invest X amount in this property because I like it. Another aspect where we're seeing very large interest is green tech, so stuff like tokenization of green bonds and carbon credits. We also have quite a few clients that are collecting funds in order to build wind farms and actually tokenize future power generation. So it's again sort of like a green bond, it's a debt instrument. And also again, illiquid classic alternative investment clauses, so art, wine, and this kind of stuff.
Art could be really interesting. It seems to be a very new emerging asset class, especially for the millennials. I saw something on Bloomberg.
Yeah, I think I agree with my friend Jan, and I think that both the assets that we'll see getting tokenized first are real estate. And I'll just give an example. Supposing your family owns a hotel. Remember the Pulte Hotel? It used to be an English comedy. Pulte Hotel, Pulte, yeah. So you own the hotel for 30 years, and then suddenly you're not so young anymore. It's hard to keep the business going, but it's located in a great place. You know, it's right by the beach, a lovely city like Sofia, and you want to stay in the game, but you want to take a little step back. So if you could sell part of the asset, like if you could share your asset by fractionally owning it and putting in a company that'll manage the asset in a new way, you could renovate it. And not only will the token holders get in on the action on a big trophy asset like yours, the famous Pulte Hotel, but you also will stay in the game. And you're staying in the game, and you're adding new blood to it, and you're making money. It's a win-win-win situation. So real estate will be the first, but I also see other kinds of assets that are very interesting. I do believe in pharma. Like I said, drugs that are been proven by the FDA. It's very different than what I do, but I see that people want that, and I have to say that it's not only the economical perspective of making a good deal that is important, it's also the personal. I see people who are investing in the tokens. Supposing I live in Japan, and I really love Greek mythology, okay? And suddenly I see on the blockchain an asset that is a hotel close to the Acropolis. I might want to get into that asset. And the millennials, they want to get into the arts. So it's going to be a new emerging market, and I believe good things will
Rao, real quick.
Yeah, I'd like to add some in this to your questions. So to answer your question, actually the best way is just to roll the clock back before tokenization. Look at the existing securitization framework. So the stocks and bonds market, they don't really need a lot of help for digitization. So before tokenization, we just use the word digitization. So which asset class can benefit from the fractional share ownership? This is exactly what I spent almost 10 years before tokenization on. We call it fragile. In our work, we call it fragile. And basically, for those asset class, in the past, there's no fractional share ownership. So from the real estate to art to yacht, by the way, I'm also a super yacht broker, dealer, all because of the technology venture we had before for fractional share. So I have consolidated all those real estate artwork and yacht into one site that I didn't mention. It's called We Co-Own, just wecown.com. And the site is still there. This is like a couple years back before tokenization. The idea is anybody, you don't need to use loan anymore. If you like a yacht, like artwork, like a hotel, like a real estate or home, you want to buy, but you don't have family and friends with cash. You post your picture on the website. Who want to join me? Everybody come in using cash to buy that. You know what's the other main advantage of this fractional share concept? That's called FARJO. Comparing that with what Young, you mentioned about commercial real estate. During that time, we focus on residential home. You know what's a major advantage? Because right now, if you only want to digitize the equity component of a real estate ownership, you will face a lot of problem in terms of legal and also the practical, custodian issue. Because you still borrow money, you still have a mortgage. The lender will put on a lot of restriction on the equity ownership. So the reason why we focus on single family home, everything just equity, no more mortgage. So there's no lender to tell you what to do, what not to do. But each individual fractional share owner, you are free to leverage that. You use, let's say you own 10% of a home. You can actually use that 10% you yourself to borrow money. And then everybody using equity to buy that house, form an LLC, a corporation to own that house. Therefore, that house has no mortgage. What is the benefit? The house will never ever be foreclosed. In one fell swoop, we eliminated the possibility for another financial crisis. There's no more mortgage. If you can accomplish fractional share, why do you need mortgage? But you cannot stop people from leveraging to get a leverage return. Why don't you do it at the member level? So that, I hope I answered the question, what asset class is prone or economically sensible for tokenization? Because right now, everybody talking about tokenization, that's nothing more than just digitization of the existing securities. Again, stocks and bond markets, they don't need much help from us. The best asset class is really real estate, illiquid assets, artwork, including yachts.
Tony?
We've actually seen it from a different angle as well, because we've been working with a lot of countries where the currency is not freely traded. So we've been working in Thailand, Korea, Nigeria, so with different assets. So to give you an example, like oil refineries in Nigeria. People want to invest into it, but they can't do it because of regulations or because of money situation. And the one thing we all know, it's so easy to invest into projects, but the problem is how do we get money back out of it? So by this tokenization model, people can invest into very profitable projects in places where they couldn't invest as a foreigner, or they could not invest because of currency restrictions or ownership. By creating local entities to hold the assets and tokenizing it and giving it to the international market, we've seen a huge amount of assets coming on board. One is mining, okay? The other is oil refinery, and also we're seeing in Japan looking at from bars and clubs as well, where people want to invest in their favorite bar or club. And also for growth factor, people are looking, they want to invest into what they like. They don't want to invest in traditional stuff anymore. They want to invest in their lifestyle, in what they want. And they also want options. The other one is in regards to CBD, marijuana. In America, it's legal in some states, illegal in other states. That's where you cannot do bank accounts because it actually breaks the law of anti-money laundering requirements. So even it is illegal in one state and not in another. So by tokenizing the farms and stuff like that for CBD, it's actually able to comply by money laundering, by international regulations, but also give different options to people to invest and also be able to sell their assets in much more profitable environments and much more accountable environments.
I totally agree with what he said. It's called democratization of ownership. Like the tokenization process allow you to choose in what to support, and even if it's not in your area, even if it's in a different regime, even if it's in a different country, and even if it's illegal where you are, you can invest like in marijuana, and that's a good thing. I think it makes the market move better. And to what you said, Ralph, I agree that it was used in the past, but the tokenization, it's in the past we had ledgers, then we had Excel sheets, then we had bonds in vaults. It was used in the past, but the possibility of tokenization and selling the token on the secondary market allows us to use the tool in a broader sense, in a more visible sense, and it lets people have trust. People know what they're buying, it makes it easier. And I agree with you also that the secondary markets that have already a secondary market, like stocks and bonds, cannot be tokenized right now, though you can tokenize debt. If you have a debt on a real estate asset, you can tokenize the debt. And sometimes they do tax schemes like that. So that's how I weigh in on these subjects.
Okay, I want to add, since Tony, you mentioned about this marijuana thing. Because if any of the audience, you want to really do something which is really exciting, you have to look for some industry that has a pool of cash, billions of money over there. Otherwise, you do the same amount of work, the reward is not as good. So, but if you look at cannabis mania, like they're consumable, right? It's sort of like you can create a tulipomania in the old days, isn't it? In the Netherlands, people started treating tulip bulbs. But there's a lot of wild story, the tulip worth more than your house value. But then the kids, all of a sudden, they saw it's a garlic, they took a bite of it. So your house disappeared. So it's very interesting, actually, if somebody can actually focus on that. I personally haven't done enough work on that, although we do provide the TurboChains for the cannabis industry, because a lot of restriction as far as in the US. And it's still a federal crime. You cannot use a credit card to purchase it, So that's a different topic. But I'm just saying, anybody who want to spend more time thinking about creating an asset token, maybe somehow, how do you package CBD or even THC, to create a market for that? And it's much more rewarding because there's just so much money, cash, in that industry.
It's just the evolution of finance. The whole thing started in the Netherlands when they started the corporation, and we're coming here now. This is like the evolution from there to here. It's like this is the modern version of the company, the stocks and everything like that. We have to move, and the thing is, the industries are moving with the times because the traditional finance, the traditional companies, the traditional situation aren't supporting them. So this is why the boom is in these industries where there's a grey area. Where there's a grey area, the opportunities arise. As long as it keeps the laws and keeps the money laundering and everything like that, there's no problem. It just actually increases e-commerce and it increases capitalism. And that's the main thing. It actually increases jobs and prosperity for people.
Yeah. So the difficulty of that is because right now there's so many growers, you don't even have a really sense of what is the supply. Because all of a sudden they open it up. Throughout America, throughout Canada, look at how many growers, how many farms, are created in this industry. So in terms of coming up with a tradable market to have a valuation on that, it's difficult, right? However, that's the double-edged sword. You have to look at it. How do you really value that, tradable package of cannabis?
So, Ralph, you mentioned the tulip mania craze, which actually reminds me of the crypto craze in November of, 2017, right? That should have been right after they added the futures to the Merc. It went up to 18,000, and I went to some events, and it felt like tulip mania. Now it seems that we're in a little bit of a nuclear winter, crypto winter, so to speak, right? So the question is, and I guess this will be in conclusion because we have about 10 minutes left. If each of you guys could describe how you yourselves are dealing with this crypto winter and how different market participants might want to handle this particular, call it crypto winter.
Okay, let me just take that first. I think the best answer to you is what Giacomo just said in his presentation earlier. Think illegal, act legal. Because that's where the fun is, isn't it? So that's where the utility token versus asset token. Because only the utility token, the value is in the eyes of the beholder. It could be anywhere. For that matter, it's just fiat currency is the same way. US dollar, Canadian dollar, euro, it's all in the eyes of the beholder. Now, all of a sudden, you become a gold standard currency, or you become a stable coin. There's no more wild swing anymore, right? So if you want to make money, I would stick to those asset class which has this, wild swing. However, you just have to follow the rules. You cannot just to play that pump and dump games.
Okay. First of all, I feel that what happened with 2017 is part of the growing pains of the market, and I think that the security token is part of that growth, and we're going to take it to the next level. People don't want such big percentiles of earnings if they are not true, if they could lose everything in a moment as well. So they want the security token. And looking into the future, I believe if tokenization is done well, from tokenization to tokenization, from every asset that we tokenize, it will be more common, and then we won't have to tokenize to accredited investors. It could be joined to the general public. And once that happens, we could see good things happening, like urban renewal, like moms in the kindergarten wanting to make a playground for the kids and having that tokenized. I think this platform has large applications to everybody, and I think we need to do a good job and make a better place to live for all of us.
Well, my feedback is twofold. A pullback in the market isn't necessarily a bad thing. It allows everyone space to actually take a breather, look around themselves. It's actually now is the time when, for example, we ran an ICO in 2017. We were lucky enough to have a bear market, which although, it does have a financial impact on your token and your reserves, it's time where you don't focus on the price of your token and you don't, have to focus necessarily on the moon boys in your Telegram group, shouting when moon, when pump. You can actually focus on building the platform. So now is actually the time to build what you promised your investors you're going to build. And on a personal investor point of view, well, this is the time where I've been personally accumulating more than I accumulated before. So, from a commercial and from a personal point of view, there's a very self-evident gameplay to be had right now.
I agree. It's actually an opportunity. Buffett says it best that when there's a greedy, be fearful. When there's a fearful, be greedy. And that's what the market has done. It's actually gotten rid of all, my friends, the bullshit companies and all the bad ICOs out there. It's actually creating now an opportunity for value investors to come into the marketplace. The real companies that actually want to deliver their products, they want to deliver to the investors. And now is the time you can see who's who and who's willing to deliver. The other part is this actually, you don't get growth by good times, you get growth through bad times. And we've seen this through all industry and everything. It's the same thing as the internet. I don't believe history follows itself, it mirrors itself. And we're in the same cycle as the internet happened. We had a huge boom, then it crashed. Okay, then there's huge development in the internet, and then the huge growth came again. Now it's a normality. If you look at the top companies in the world, they're technology or technology-based. We're going through the same thing now in the whole blockchain crypto market. This is the opportunity to build, create the foundation, because the second part will be coming, because everybody will be coming back to it soon enough. Before anybody asks, I'm not going to say where I'm predicting it or anything like that, but it's a human nature where there's opportunities if you look at them.
And does anyone in the audience have questions for the panelists? Yes. You can just tell.
Can someone here, I'll give you my mic.
If I see a lot of lawyers worldwide, they all tell us at least you have to cover 210 countries regulatory before you develop your product and you can go for your product. My question to the audience, do we care too much to all the existing stuff, and do we not take care too much to build more and more our own ecosystem, our own system where the people at least accept things? Do we not take too much care on the old industry while we are continuing with our projects?
Very good question. Who wants to go for it?
So to recap, the question was, are we focusing too much on...
Basically traditional, like why not? I believe the question was, are we focused too much on the way securities and traditional business has been done and not just on the new stuff?
To be honest, there's a fair point in that. However, you do need to bear in mind that no economical ecosystem lives in isolation. Capital flows, the world is a single market, capital flows have to flow, through all markets. So for any particular market to flourish, capital has to flow from one other market into it, and then obviously it has to flow out of it as people take their profits from it. So whilst, yes, sometimes, through lack of choice, we see a lot of projects, a lot of clients need to kind of bludgeon their vision in order to fit around the regulatory framework. Unfortunately, there's nothing you can do about it. And once there's, the only thing stopping an issuer going out and going rogue and running, selling a security without licensing is the threat of jail time. And there's, no physical impediment to stop them from doing that. Ultimately, it's not a winning mentality. It's not going to get you anywhere. So unfortunately, the way we're going to have to play this is we're going to have to, go along with the game and slowly change it as time goes on. As there's more money, as there's more players, as the ecosystem becomes more self-sufficient, then we can stand on our own.
Okay. I know exactly what you're saying. I have a company that I will remain, it will be anonymous because it didn't come in, who wanted to do some commerce, and I was consulting them. And then they did market research and they found out that there wasn't an ability to do it because of the ecosystem. And I come to realize that this whole industry has grown as an investment industry. But I believe that in time, we have companies that are dual, like they're both investment and a commodity. Like Solid Block, a company that I consult, we do fractional ownership of real estate. So real estate is an asset, but if you're living in it, it's a home, so it's a commodity. And more and more companies that are dual will lead the way to making the new ecosystem for areas that are unmapped or untapped or unmade yet. And that's how I see the market growing from company to company. And the most important thing is to have a business that is growing out of a need, out of pain, and it'll be successful. That's what I believe.
I think it has to be accountability, and that's the thing. Is that, if we ignore what the current systems, the current ecosystems is, it will turn on the industry and it will just consume it. From regulators, from the consumers, from businesses, they will all turn on the industry. So I think everybody has to play nicely at the moment, but the thing is there's so much development been in 5 years in this industry, in the next 5 to 10 years, okay, then it's a level playing field. It's like we cannot take the whole industry on at the moment. We have to do it slowly. It's like they're trying to change a ship at sea. You have to do it slowly to change course, and I think that's the case we are at the moment.
I just wanted to thank you guys for attending, as well as the audience. Are there more questions?
Hi guys, thanks for the insightful panel. I'm not seeing the revolution here. Is there really something super, super cool happening?
The revolution is never going to happen in the context of this panel because these are securities and these live within existing financial frameworks. So there's not going to be anything exciting or sexy happening over here. That's happening at the protocol level. I think some of the stuff that, for example, some of the protocols like Stellar are doing for remittances, some of the layer 2 solutions that are coming out are really exciting. There's some new implementations of stablecoins that do not necessarily require a fiat reserve to maintain their value, yet they are actually backed through a tokenomic mechanism. That's really exciting. So there's some really cool stuff happening, but again, not in the context of STOs, because everything here happens under a financial regulator or a banker's purview.
Exactly. It's finance. Okay, there's nothing sexy about finance. So, but this is what everything is based on, and everything grows from here. If you're looking for sexy, I think that's the next panel coming up after us, but okay, except for good-looking people, okay, that's the only thing that's sexy about this. But the whole thing is, this is finance. You can call it anything you want, but this is finance. Everything else flourishes because of finance and the structure we put into place, and how we put it into place, and how we use it.
So my, sort of final word about the trend for this industry, I just want to add in the end. And basically, what is dangerous right now, is really the establishments to come in to squash all the small entrepreneurs. As you can see, what's going on now, from a stable coin, JP Morgan, or the Facebook's gonna, issue their own token. So what it meant to be a lot of democratic small investors, small entrepreneurs to build a new industry, right now we saw the establishment come in, to hijack everything. By using just on the conceptually trying to understand what a stable coin is. Initially, when we already have a Bitcoin, right? Then people are actually now switching. If you look at even the media, they keep talking about stable coin. But what is a stable coin? Stable coin is nothing more than a digitized fiat currency. But the fiat currency has no backing either. It's just what Uncle Sam tells you, what the value is. So what this really just indicates, the establishments, they are hijacking what the Bitcoin is supposed to be. If you say that there's a volatility for Bitcoin, the volatility toward what? If you say there's a revolution, maybe Bitcoin is stable. It's a US dollar that's having a high volatility. So I hope you get my point in terms of that stable coin concept, If everybody just, go after the Bitcoin and believe in Bitcoin, so what if the Bitcoin value, that's where the future is. If the US dollar euro doesn't match up, that's your problem. But what you've seen within the past last year, past couple months, is really the capitulation of the cryptocurrency industry by switching back to stable coins. Do you hear it? Do you hear it? Do you hear it? That's the quiet before the storm. That's the quiet before the storm. We're only having a few one commercial asset that is publicized, is tokenized. That's the Aspen coin. We have a couple of more in the woodworks, but once we get it right, 1, 2, 3, 4, 5 times, you'll see a tsunami of tokenizations. And the security tokens, you'll see it happening all the time. And then after that, in a couple of years, you will, instead of working, you're playing on your stocks and work. People play on their stocks and work. You'll see people switching coins of assets, trophy assets, and that's what's going to happen. That's the storm. It's just quiet now because it's coming.
Any more questions? Okay. Thank you, everyone.